What is your first thought when you hear the word crypto? For some it's easy gains and fast cars. For others it's online scams. For people like us, well, it's regulation. In this first video of the series on digital assets regulation, we talk about how regulation on crypto assets is strengthening relations between the UK and the US.
Tonight, we are leaving the European Union. For many people, this is an astonishing moment of hope, a moment they thought would never come.
If you follow this channel, you know that in the past we talked a lot about Brexit, but we concentrated on one particular dimension to Brexit, the one shaped by the loss of passporting right and characterized by difficulty for UK-based firms to legally maintain or gain for the first time access to the single market for capital and financial services in Europe. Contrary to popular beliefs though, the recent story shows us that Brexit didn't just close a door on the European market. By regaining legislative sovereignty and with that control over its political agenda, free from the legislative and political constraints of being part to the European Union, the UK had a lot more freedoms. Also to craft a regulatory regime on crypto assets tailored exactly to the needs of its own market, inspired by its own principles of proportionality, like same risk, same regulatory outcome, aligned with its own priorities of consumer protection and with the goal to remain a global capital for financial services. It is recent news that the UK was the first ever state to enter a trade deal with the US. It is not as known though that there exists a US-UK Financial Regulatory Working Group, a forum instituted by the US Department of the Treasury and the HM Treasury, joined by representatives from their respective financial regulatory agencies for the purpose of fostering bilateral cooperation and enhance financial stability. The June 2025 meeting of the UK-US Financial Regulatory Working Group highlighted significant progress in bilateral cooperation on digital finance between the two countries. Both nations reaffirmed their commitment to fostering innovation while implementing proportionate regulation on crypto assets to manage related risks. The forthcoming crypto regulation in the UK, aligning with principles embraced by the US already, signals that the UK is receptive to well-managed international businesses active in the crypto space, and in the post-Brexit era aims at becoming the destination of choice for US crypto firms. As part of the endeavor to establish a crypto assets regime, the HM Treasury in the UK proposed new rules in April 2025. And that's the long-awaited Financial Services and Markets Act order on crypto assets. But the journey on crypto regulation in the UK started way earlier. In January 2020 is when crypto assets exchanges and custodian wallet providers were brought for the first time under the anti-money laundering and counter-terrorist financing framework of the UK 2017 money laundering regulations. These firms had to register with the FCA and as part of that process implement robust procedures for customer due diligence, monitoring of transactions and reporting of suspicious activity. This initial step was meant to target financial crime as a matter of urgency, but left unaddressed other aspects such as prudential requirements, governance standards, and consumer protection. The method adopted by UK authorities for the legislation on crypto assets is interesting. The UK opted not to create a bespoke separate regime for crypto assets. This avoids a situation that could lend itself very easily to overlapping obligation or uneven supervision compared to traditional financial services. By embedding crypto within the broader framework of the Financial Services and Markets Act, the UK ensures that digital asset activities adhere to the same integrity standards as other financial services, while allowing the FCA to craft tailored rules through its general rulemaking powers. Rather than applying existing FSMA rules automatically to crypto assets, the FCA will receive powers to draft tailored rules, steering clear of retrofitting an outdated regime to a novel asset class. The government has also declined to expand the definition of financial instrument to include unregulated crypto assets, recognizing their unique features and risks. Two are the founding principles of the UK crypto assets regulation. Proportionality, meaning that the same outcome will drive the same regulatory response compared to other traditional mainstream financial services. Technology neutrality, which is not a new principle, and it's adopted by other global regulators and focuses on whether the use of technology introduces or mitigates risks, rather than on the technology itself as a source of risk per se. To implement the new regime on crypto assets, the HM Treasury in the UK is proposing to amend in the first place the Financial Services and Markets Act 2000 Regulated Activities Order, known also simply as the Regulated Activities Order. That's a piece of secondary legislation in the UK governing the activities carried out in relation to certain investments deemed to be regulated activities by the UK FCA and covered under the main prohibition of the Financial Services and Markets Act, where this cannot be carried out without an authorization from the UK regulator. Key changes include defining qualifying crypto assets and qualifying stablecoins as the primary classes affected. This will be classified as specified investments under the Financial Services and Markets Act, akin to traditional financial instruments. Activities such as operating a trading platform, dealing as principal or agent, arranging deals, safeguarding, custody, staking of qualifying crypto assets, and issuance of qualifying stablecoin will become then regulated activities, requiring FCA authorization for firms conducting them by way of business. Arrangements related to stablecoins will not be treated as collective investment schemes or alternative investment funds. These amendments to the Regulated Activities Order will trigger corresponding updates of other pieces of legislation like the Financial Promotion Order and the Money Laundering Regulation to align the respective scopes. But it is the geographic scope with any potential extraterritorial effects of the rules of the crypto assets regime in the UK, the element of concern for overseas crypto firms, starting from the one in the US. The main trigger for authorization under the Financial Services and Market Act is the fact that crypto assets firms serve UK retail clients, regardless of the location of the firm. So not any type of client, but retail clients in the UK. Activities like operating trading platforms, dealing and arranging deals will require authorization when UK consumers are engaged and exposed directly or indirectly, unless an authorized intermediary is involved. The regime on UK crypto asset firms also provides for an exemption. If there is an authorized intermediary involved between the firm and the UK retail client, and the intermediary is authorized to carry out the specific activity or provide relevant service on crypto assets, then the crypto asset firm dealing with the intermediary does not need to be authorized. Staking will trigger authorization if conducted in the UK or for UK consumers. Stablecoin issuance will require authorization only if carried out from a UK establishment. Overseas firm will not require authorization if serving only UK institutional clients, under the conditions that those clients are not intermediaries to the retail markets. Overseas crypto assets firms, including the ones from the US, will not be under the geographical scope of the UK crypto assets regime if they provide their services only to UK institutional investors, and this is in stark contrast with what happens in continental Europe under the local MiCA. And let us know in the comments if you want to know more about the differences between the UK and the EU regime on crypto assets. And if you made it up to this part of the video, I wanted to thank you, and I wanted to invite you to hit like to the video and subscribe to the channel. There is more to come on digital asset regulation. Thank you for watching and stay tuned.